and let's say at least the parts of 2024 and that your headlights feel comfortable talking about here, what are you looking at right now? Because the vibe I got from you sort of earlier is feel pretty good in the near term, right? So is it sort of game on for everything, or are you worried at all about how far and how fast stocks have gone, or any other assets?
Well, I think one of the fun things about being a macro investor is you can pick the trades that you want to pick and not pick and not trade the things you don't want to pick. And that's an important thing. You don't have to trade every market. You don't have to think about every market. You just want to
Great
find the
point.
best opportunities. And so I think coming into the year, the best opportunity seemed relatively clear that we were probably not going to have 7 cuts that were priced in to the US. And probably there was going to be pressure on bond yields to rise, and for stocks to outperform bonds. Now, the reality is in the last 6 weeks, pricing has changed a lot. Just before we got on here, I was looking at it, and now we have 3 cuts priced in for 24, not 7 cuts priced in. That's a heck of a move, particularly in 8 weeks. That's a heck of a move to have seen over that time frame. And so now interest rate policy on the short end is kind of reasonable. Maybe there'll be less than 3 cuts because the economy is stronger and inflation is a little higher. But you don't want to pick trades that are, the difference between 3 cuts and 2 cuts. Who cares? No one has that level of precision, right? The difference is between 7 and 3 and 2, right? That's what you want to trade. And so right now, when I look across the overall financial markets, you have a strong economy, you have elevated inflation pressures, you have a Fed that probably is going to be a little more cautious than what many people had expected. And I should add, and you have large fiscal supply that's coming into the market that's going to pick up by 50% on a net issuance basis in the second quarter of the year. And so the real question is why are bonds, can bonds continue to be priced in a way where, there's essentially a 0 term premium on the long end of the bond market, given that set of macroeconomic conditions? It seems unlikely we're going to see that. And so yield curve steepening seems like one of the most compelling dynamics right now. Right now we have an inverted yield curve, and we still have an inverted yield curve. And so seeing a shift to a steeper yield curve environment seems compelling, given what's happening with the macroeconomy, and also what's happening with the overall flows dynamics. So that's really what I'd center on. And that impact on stocks.
I just want to make sure the viewers are following you here.
Yeah.
So when you talk about a steepening of the yield curve, I believe you're talking about the long end of the curve catching up to where short-term rates are right now versus the other way around, right?
Exactly.
Which means that bond prices will come down. Bond prices
will come down, yields will go up. That's exactly right. Is that a lot of the tightening, essentially a lot of the tightening that we've seen so far has been really the short end dragging up the long end, rather than the long end reflecting the underlying strength in the economy, the inflationary pressures, and the bond supply. And so, that's the sort of thing that can continue for a period of time. But it's almost like each day the recession doesn't come, the long bond holders look at themselves and say, ooh, this may not be the right trade here. I'm not sure I necessarily want to hold this much duration. I might not want to hold as many bonds as I'm holding right now, just as the supply of the bonds coming into the market is rising substantially. And so that really looks like the best opportunity when I scan across the markets and look at all the different things. Now, most people don't care about trading yield curves or short rates. They probably mostly care about equities. And what I'd say there is, we've gotten a heck of a run of stocks, in particular relative to their performance versus bonds. We've got a heck of a run on that. And the economy is strong, but it's going to be tough to meet the level of expectations, particularly in earnings that exist in the market, whether it's in the Mag 7, but also, S&P 493 is expected to have, higher double digit year-over-year earnings by the end of the fourth quarter. It's going to be tough. That's going to be tough.